Hey, this is Mike Swans, the Wall Street Window. I want to give a quick update on the stock market. And I want to show you where the strength is in the market. Every day that the market trades, there are things to be learned if you look at what's happening inside the stock market itself. What are individual sectors doing? What are individual stocks doing? When you flip on the TV, when you flip on the website, when you flip on the app, you see this. Dow, it's down 482 points at the moment. It's down almost 1,000 points so far this week. Now, that's not something to be scared about, and I'll show you why in a few moments. But the VIX is up 7%, and here's the headlines. Morgan Stanley cutting 2% of its workforce. Jamie Dimon saying inflation's hurting consumer wealth. And so forth. But these headlines don't help you understand what's going on inside the stock market. Yes, it's important to look at the averages, and we can learn something from that. Here are the QQQs, the NASDAQ 100, the 100 biggest big cap tech stocks. And what's important about them is what you see on the bottom of this chart. That is a relative strength ratio. Taking the QQQs, dividing it by the price of the S&P 500, and you can see the ratio has been in decline all year. And when the market rallied in October, the ratio is actually lower than it was at the start of the rally. Why does that matter? What it means is that the QQQs are lagging the S&P 500. The NASDAQ is lagging the S&P 500. That's bad if you've got all your money in big cap tech stocks, because when something lags the S&P 500, when the stock market just has a pullback, those stocks and sectors tend to fall much worse than the market and then fail to rally enough, to do that well when the market does rally. And that's what's happening with a lot of the big cap tech stocks. For example, if you look at a chart of Meta is actually one of the 10 worst performing stocks in the entire S&P 500 today, down almost 7%. And you can see its relative strength has been a disaster, and it barely even bounced on this market rally, even though Meta did have, what seems like a substantial bounce. But the bounce means absolutely nothing when it's so far down, and Meta isn't even at its 200-day or 150-day moving average. It's at its 50-day, when, as you can see, the S&P 500 is just right on its 150-day moving average. What has happened is we rallied up into the 200-day moving average, and now, we're encountering resistance on it. And I think the market is going to stabilize, go sideways, and then have another attempt at a rally before the end of this year. But if you want to beat the market, and what I'm about is helping you do that, then you want to be involved in stocks, sectors that are beating the market. And we're going to look and see what is doing that today. But as I've said in the previous videos, I'm not that concerned about the drop recently in the market. And the reason why is because the TLT ETF is up today. The LQD ETF is up today. What will make me worry is if these are going down, because that would mean yields are going up, and that would be a bad sign. That's what happened in the beginning of August, and it warned that, hey, this stock market rally, don't pay attention to the bulls and what they're telling you about pivots. Doesn't matter. It's all going to fall apart. But that hasn't started to happen yet with these ETFs, and hopefully it will not happen for the rest of this year. So where's some of the strength? Well, when you look at the market today, the GDX ETF is up. I own this ETF in my retirement account, and some of the individual stocks are in my main account. The price, and it's a big cap mining stock ETF. The price of gold, as you can see from GLD, is up 0.31%. And it's the relative strength is up all year. That's what you want to look for. Situation where relative strength is up all year and continue to do well in this recent rally in the market. Now, what I want to show you is software that I use to analyze the stock market. And that software is mainly the TC2000 software. And what it enables me to do is do some quick analysis. So I'm now looking at all the components of the S&P 500, all 500 stocks, and at a glance, I can see what is down the most today. Energy is down. Meta, number 3, worst performing stocks. Paramount Global, Advanced Micro, Expedia, Bank of America, Hasbro, Fidelity, Match.com, Charter Bank, UPS, Domino's Pizza, Marathon Oil, CarMax, Chipotle, MasterCard, and so forth. What's up the most today? Out of curiosity, we can see that Textron, Exelon, AT&T, American Power, Everest, CBOE, United Airlines, Southern Company, Chubb Corporation, Lowe's, Edison International, Duke Energy, Twitter, Cigna. These stocks within approximately 54 stocks are what are up in the S&P 500 day. But one day of action doesn't really mean that much. What is more important is if we can see what are the leading stocks since that's just what's led the rally. Let's just ask that question. What's led the rally? And what has led the rally is what I'm going to sort by relative strength, by the performance since the October low. As this stock got bought out, Moderna, Boeing has been one of the leaders of the rally, and Boeing is in the Dow. It's one of the stocks that has lifted the Dow up so much that, you know, you've seen what the Dow has done. Universal Healthcare, Gilead, Royal Caribbean, Netflix, United Airlines, Caterpillar, again, one of the major Dow components is Caterpillar, Free Pratt McMoran, General Electric, Caesars Entertainment, Halliburton, NVIDIA. But what's been lagging the market? The stocks have been lagging the market are the stocks that are truly dangerous. As I said, they act as millstones in an account. Laggards are the worst things you can own. The worst performing stock in the entire S&P 500 since the October low is Generac. A bank stock is next. Amazon is one of the biggest laggards now in the entire S&P 500. Amazon is a disaster. Would they tell you that on CNBC? Would they tell you that on Twitter? If I owned Amazon, I would sell. Even if I had a loss on it, I would take that tax loss and move that money into gold and silver, or find something that's beating the market. That's what I would do if I owned Amazon. Amazon, one of the stocks we were told was a must own for years, is a stock market laggard on this rally, a complete disaster. So is Tesla. Tesla remains one of the most owned stocks among all Robinhood traders. If you have a Robinhood account, load up the account, you'll see it's right at the top. Despite the fact that it's a laggard, it is crushing people. Get out of Tesla if you own Tesla. The same goes for PayPal. PayPal is a complete and total laggard. So is Facebook, which I mentioned before, even with the bounce. Salesforce, a laggard. Take-Two Entertainment, a laggard. Boston Properties, Warner Brothers, Paycom, Essex Property, Devon Energy, Walt Disney stock, a horrible laggard. It's down today from the October low of the Dow and S&P rally. It's actually down. It's at a danger spot of getting tax loss selling. Even if the stock market does okay, even if the market rallies more before the end of the year, which I think it can, or probably will, Disney may not. That's why Disney's a disaster. Tax loss selling is going to hurt it. It's no good. ResMed, Intuit, NetApp, Capital One, Alphabet, Google is still a laggard in the market. Google is a stock to sell. It's a stock to get out of. I know people want to hear buys. I know YouTube is flooded with videos of buy, 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 but sometimes it's more important to know what to sell, especially when everyone else owns it. Get out of Amazon, get out of Google, get out of Tesla, get out of Meta. These are laggard stocks. They're millstones in an account. Get out of them. It goes for Qualcomm too. It's a laggard. It's a disaster. Get out of it. Get out of it. Get out of those. You know, if you don't know what to buy, put it in gold and silver, put it in GLD, put it in GDX, the mining stock ETF. Apple is now a laggard. Apple, we were told for years that you have to own Apple, and now it's a laggard. It's a disaster. It's barely up from the October low. And you can see all the news in China about what's going on, that Foxconn plant. CarMax, even though CarMax was a top gaining stock. Oh, no, it wasn't. I thought it was for today. Micron is a laggard. Again, you may notice big cap tech stocks, laggards. They've been lagging all year, and no surprise when the market rallied, they've lagged on the rally too. They were lagging before the October rally, and they're continuing to do that. That's what laggards do. They act as millstones. Get out of them. And there are funds such as the ARK ETF that are complete debacle laggard funds. You can't see the red indicator on this chart. I know it's tough to see on YouTube, but that's my relative strength indicator on here. It's on a new low today. It's a disaster. Get out of ARK, buy gold, or short ARK, go long gold if you like to do pair trade situations where you're long and short. Long gold, short ARK. That's what I believe would be a winning situation now for the next several years. So, you know, we can get an idea of today just by looking at what's going on inside the market, which this software enables me to do. What are situations that still suck? What are laggards in the market? Get out of them. What should we buy? Well, we saw, you know, the gold and silver is doing well. We saw some other individual stocks doing well. But, you know, seeing what is outperforming when the market has corrections is a useful thing to do. And you can see on this down day that gold and silver are continuing to do well, but gold and silver have been leading the market, outperforming the S&P 500 now all year. So what's happening today is not unusual, and I think it's going to continue because, as I said in previous videos, I think one of the big macro shifts happening is with the Federal Reserve going from 75 rate hikes, size of rate hikes, to now 50, which is expected, is slowing the pedal on monetary policy, which is weakening the US dollar. And when the Fed gets to the point where they're going to pause and not hike, that's going to weaken the dollar more, and gold and silver benefit from that. So that's why I believe in them. I think they're important. It's a tricky market. Don't let anyone kid you. This is not easy money to be made. This is not 2020. It's a completely different market environment, and you have to adapt to that. You have to adjust to that. You have to get out of the millstone situations. You have to go into where the strength is in this market. And right now that's gold and silver. And we'll be watching this situation as it develops. Now, if this is the first time you've seen me on YouTube, click the subscribe button, click the bell next to it. YouTube will send you an alert as soon as my next video is up. And if you're not on my free email list yet, scroll below, subscribe to get on it. You'll get my morning market thoughts with some specific action ideas in them typically. So all that said, I'll be talking with you later, and we'll see what happens tomorrow.